Right now, everyone is fixated on the flashing green tickers of the stock market. They are hypnotized by the AI bubble, watching tech stocks surge and semiconductor companies trading at 40 times their actual earnings. The traditional financial media insists the economy is booming. This economic strength is built entirely on borrowed money. The United States government is sitting on over $38 trillion in national debt, spending $1 trillion a year just to service the interest. As the government maxes out its credit, the average citizen follows the same financial logic. Total household debt in the United States has climbed to $18.6 trillion, a level that dwarfs all previous historical peaks. Debt has become the duct tape holding the entire macroeconomic system together. But not all debt carries the same level of risk. While mortgage debt is backed by real estate, an asset that historically appreciates, the real poison is leaking from the non-housing sector. This systemic risk has four wheels, is parked in your driveway, and loses value by the second. The ultimate symbol of the American dream is now a multi-trillion-dollar ticking time bomb of depreciating assets. Buying a car used to be a mathematically sound transaction. You went to a bank, secured a standard 48-month loan, and eventually you owned the vehicle outright. Today, financing a vehicle involves a massive mathematical flaw. You take on long-term debt for a piece of metal that loses 20% of its value the moment tires touch pavement. This creates a wide gap between what you owe and what it's worth. The buyer is trapped underwater, carrying negative equity. Driving a financed luxury car is an indicator of financial self-sabotage. Net worth bleeds out through compound interest, while the asset providing the status disappears. Dealerships have weaponized a dark application of Goodhart's law. They realized that the average buyer stopped optimizing for the total cost of the vehicle and started focusing entirely on the monthly payment. To mask skyrocketing vehicle prices, lenders simply stretch the timeline of the loan. They sacrifice the buyer's long-term financial health for the sake of short-term affordability. The 84-month auto loan is marketed as financial flexibility. In reality, it is a wealth destruction machine that locks subprime borrowers into 7 years of debt for a rapidly aging asset. Dealerships now regularly roll negative equity from an old vehicle directly into a new 84-month loan. You end up paying interest on a car you no longer own, just to drive a newer model you don't own yet either. This trap sees everyday people financing used vehicles at a 14% APR, committing to payments that far outlast the car's peak reliability. The modern dealership model ensures the middle class becomes a permanent generation of bag holders, paying premium subscription fees to banks for the privilege of driving. At the institutional level, the consumer serves as the yield. Banks and private credit firms aren't selling cars, they are harvesting interest. Wall Street bundles these toxic subprime loans together. They create shiny new asset-backed securities, stamping them with high credit ratings. Institutional investors, desperate for returns, buy up these packages, unaware of the deteriorating quality of the underlying debt. These structures are mirrors of the collateralized debt obligations that collapsed the global economy in 2008. The entire system relies on the American consumer continuing to make that monthly payment, even as their cost of living rises. Wall Street has rebuilt the same subprime debt bomb, but the collateral is millions of underwater vehicles parked in repo lots rather than real estate. The macro environment is shifting. Global liquidity is tightening and borrowing costs are staying high, forcing all forms of consumer credit to become more expensive. With cumulative inflation at 25% and stagnant wages, people are now using installment plans just to afford basic groceries. Credit card balances have crossed the $1 trillion mark. Average interest rates are now hovering around a record 21%. In the world of auto lending, a repossession is the ultimate margin call. Missing 2 payments leads to immediate seizure, a destroyed credit score, and a deficiency balance that can follow a borrower for years. Across the country, repo lots are quietly filling up. The secondary market is flooding with seized inventory. When supply skyrockets and demand evaporates because capital is too expensive, the residual value of these vehicles plummets. As asset-backed securities default, shadow lending tightens overnight. The easy money disappears, and the automotive industry grinds to a devastating halt. This crash won't be announced by a bell on Wall Street. It will happen late at night, as a tow truck hooks up to a vehicle that was never truly yours to begin with. The system was meticulously engineered to function this way. You have to ask yourself, are you building wealth, or are you just financing the illusion of it?